Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a former Wall Street analyst. He won awards, actually, on Wall Street for being one of the top analysts. He runs the Dollar Collapse website, and he co-authored books with James Turk on the dollar collapse almost around 10 years ago, and his most recent book is The Money Bubble. John Rubino, thank you for joining me again.
Hey, Jason. Good to talk to you again.
Now, John, so you've written I've read both of those books. They're very good books. And, you know, here we are 10 years later, about 10 years later since the 2008 financial crisis. If I were to go back in my time machine and tell you all the stuff that these 5 or 6 central banks would have done to get to where we are now, and the dollar wouldn't have collapsed, and the money bubble would have expanded to tens of trillions of dollars in liquidity being thrown around, what would your reaction have been?
Well, my reaction would have been that is highly unlikely. You know, when James Turk and I were writing The Coming Collapse of the Dollar back in 2004, our biggest worry was that we weren't going to get the book out in time before all its predictions came true. You know, the global financial system, even back then, looked so shaky, so over-leveraged, so ready to go that it seemed like it could happen anytime. And, you know, it actually almost did. In 2008, 2009, we had a near-death experience. We had a debt-driven crisis that almost wiped out the major banking sector in the U.S. You know, the big banks on Wall Street and elsewhere would have all died. And that includes J.P. Morgan Chase and Goldman Sachs. They would have ceased to exist if the government hadn't come in and bailed them out. And, you know, beginning with the bailout, as you said, we embarked on some really extraordinary policies. You know, we basically tried an experiment to see what would happen if we have the world's central banks buy up most of the high-grade bonds in the world, and some central banks buy up a bunch of equities, and all the central banks push interest rates down to historically unprecedented levels, including negative levels in a lot of the world. And that stopped us from having a 1930s-style Great Depression, which we probably would have had if all the big banks just died in 2008. Imagine what that would have been like in the financial markets. But it came at a cost. And that cost is, as you said, tens of trillions of new dollars of leverage in the global financial system. And actually more like $100 trillion if you accurately account for the amount of debt that we're taking on in the form of unfunded liabilities and derivatives and et cetera, et cetera. You know, we've taken on an absolutely insane amount of debt in order to keep us from having to pay the piper for the previous insane amount of debt that we took on. So now the question is, can we do it again? You know, another recession is coming, of course, and another bear market in equities is coming just because, you know, if for no other reason, the current expansion is like 9 years old and the bull market is that old. And those are both extremely long times for positive things in financial markets to go on. And we're seeing so much volatility out there all of a sudden, which is reminiscent of what happened in 2007 in the stock markets before they tanked. You know, you had these huge up moves and huge down moves back and forth, and everybody was getting whipsawed, and then finally it fell apart. This feels like that again. Not saying that it definitely will be, but it has that feel, and we're so far along. You know, valuations are so high. The bull market in financial assets in general, not just stocks, but bonds and leveraged real estate and et cetera, et cetera. They've all been going on for such a long time that it has to end pretty soon. Then the question becomes, will central banks let this process play out? You know, even though it's going to be systemically very dangerous to have stocks fall even by 20% and real estate lose a lot of its value the way it always does in recessions? Or will they jump back in because they're terrified that there's so much leverage in the world that any kind of a hiccup will push us off a cliff? And then what will they do? That's the question. You know, what kind of experimental policies will the central banks of the world try next time around? And I think what they did last time gives you an indication of what they'll do next time, just more extremely. You know, they'll buy more equities. Already the Japanese central bank is one of the big players in the local equities market. The Swiss central bank has this huge portfolio of global blue chip stocks that they made a lot of money on for a while there. The U.S. probably secretly intervenes in the stock market here, but they'll do it explicitly if there's trouble. Janet Yellen, before she left as chairwoman of the Fed, is on record as wishing for the power to buy equities. She said it would be really nice if we had the ability to buy assets that have a more direct relationship with consumer behavior. In other words, push up people's stock prices. They'll feel rich and they'll go out and borrow money to take vacations and buy, expensive cars and big screen TVs, which to a Keynesian is good. That's how an economy should work. Of course, it's not how an economy should work. But since the guys running pretty much every major monetary authority in the world believe what Janet Yellen believes, we will definitely start buying equities next time around. Now, on the interest rate front, a lot of European countries, along with Japan, found out that you can have negative interest rates and the world doesn't blow up around you. So that'll be a part of the policy next time around, too. We will push interest rates not just to zero like in the U.S., but we'll push them into deeply negative territory, if that's what it takes, all around the world. Now, the idea that gold and silver will just sit there when central banks are creating enough money to buy up, half the S&P 500 and 2/3 of the issuance of governments, bond issuance of governments, and pushing interest rates down into negative territory it's hard to imagine. Well, it seems like gold and silver would be the big beneficiaries of that kind of a world.
In a free market, yes. I mean, you and me both agree that the gold and silver price has been manipulated. So with paper futures contracts and other games. Did you see the statistic that Dr. Harold Malmgren put out? I'm not sure where he got it from, but global central banks, if you include the People's Bank of China, and this is only what they release in public. This doesn't count currency swaps, which technically central bank to central bank, they don't list on their balance sheets publicly. And supposedly all these central banks, John, like the 6 largest ones, they have 45% of global GDP on their balance sheets right now.
That's not at all a surprise because they've been pumping out that kind of currency for such a long time. You look at Japan and the Japanese bond market hardly trades because the Japanese central bank owns all the government bonds. There's no reason to trade when the central bank will just buy your bond from you or has already bought your bond from you. That's not as true, but almost as true in Europe. And then, the U.S. bought the majority of the Fed's or of the Treasury's issuance of bonds for most of the last few years. So yeah, it's not at all a surprise that that we've done what looks like a leveraged buyout of the capitalist private sector over the past decade, and all that did was get us to a point where there's another big recession coming and another bear market that'll be just as devastating or more devastating than the one that they spent all that money to prevent last time or to stop from progressing last time. So this time around, in one sense, they're kind of limited in what they can buy. I mean, how many more bonds can the Japanese central bank buy when they already own them all, And so that's going to be one of the challenges. What do you buy if you already own the normal stuff that you would buy? They're going to have to go into the private sector even more deeply, I think.
They're getting into theoretical territory. They floated as a trial balloon a year or two ago that they were considering issuing like 100-year bonds and transferring a lot of the Japanese government bond debt into that and just inflating it away, printing up more currency and turning that. So I don't know if they'll actually do it, but they're at least discussing it. So go ahead.
Okay, they would love to be able to do it. And the question then becomes, how will the currency markets and the asset markets react to that? Why would anybody hold Japanese yen if that was the explicit policy of the Japanese government, right? Mm-hmm. If you're rational, you wouldn't own that kind of a currency. And if all the other big countries are doing similar stuff, you wouldn't own those currencies either. So, you go to Bitcoin. If cryptocurrencies are still functional, you'd go to gold and silver, you'd go to farmland, energy assets. You own things that governments can't just inflate away as part of some really misguided policy to keep people borrowing money. So, when that happens, you would think that commodities would do pretty well. And nothing is guaranteed in this world, because when you've got such big, powerful players and they're manipulating markets, they can make illogical outcomes happen just by brute force, by creating so much currency and tossing it against an idea that the idea plays out, even though it's a completely irrational idea. Well, that can happen. But if it doesn't, then all the forces in the financial universe are lining up in favor of commodities and real assets and against fiat currencies and other financial assets that are based on fiat currencies.
So I got a couple of points for this. I obviously really liked the money bubble. I thought it was great. I really enjoy it. For our listeners who haven't gone out and read the book yet, it's available on Audible audiobook. And you guys talk in there about currency swaps. I think that's important. James Turk was an investment banker. Currency swaps have been done for many years on Wall Street, but normally in the past for bailouts, whether it was the Asian crisis or the Mexican crisis, they were a lot smaller in size. 2008 was really one of the first years where it was central bank to central bank currency swaps in the trillions in size. But George Soros said, John, get your comments on this. You said the system was resuscitated. George Soros said that in 2008 the system died and it did not recover, and that the stuff that's going on now is basically like a zombie. So, we have the appearance of banks being functioning and kept alive. Deutsche Bank is the European banking system, and Deutsche Bank is a joke. The European Central Bank, their balance sheet now is larger than the Fed's at $5 trillion. So did you guys, when you wrote Dollar Collapse and Money Bubble, did you anticipate these types of rules changes and bank bailouts? Did you think that we would get to the size, or did you think that, Wall Street and other people would object to all this currency printing?
Well, when we wrote Dollar Collapse, the Coming Collapse of the Dollar, we did not expect this stuff. That was back in 2004. And, the whole QE negative interest rate thing came as a surprise. When we wrote the money bubble in 2014, it was already well underway. And it was, obvious that it was going to continue for quite a while longer. So George Soros' idea that the old system died with the advent of QE and negative interest rates, and this is some kind of a zombie thing, is not unreasonable. It's definitely one way of looking at it. But still, the question is, how long can you keep the zombie shambling along, and what do you have to do to make that happen? Because if you're a central banker, the one thing you don't want to happen is have the markets force you to give up your power. You can create money out of thin air if you're a central banker, and you can spend that money that's been created out of thin air if you're a legislator or a president. And that's awesome. That is the most fun thing to be handed that you can imagine, right? I mean, what would you rather have than the ability to create money out of thin air, other than maybe immortality? And even then, I'm not sure.
Alchemy.
And these guys, yeah.
turn some cheap metal into gold.
Well, that didn't work out for King Midas. So, but it has worked out for central bankers. Alan Greenspan, who is just, he'll eventually go down in history as a monster, an absolutely clueless bureaucrat who created the nightmare that we will soon be living through. But he's a rich, famous guy who's treated with respect everywhere he goes. So the unlimited printing press has worked out beautifully for its possessors over the past 30 or 40 years. Eventually, that kind of thing blows up on you, obviously, because you end up creating so much currency that the currency becomes worthless. And that's the dollar collapse thesis, and that's the money bubble thesis. And it's taking way longer than it seems like it should, but it's still going to happen because, the supply of currency keeps going up. And that's how bubbles work. The prices and the behavior in a bubble market keep going beyond what a rational person would think possible. And it kind of discredits the rational person. And towards the end of bubbles, you see all the critics of the bubbles stop talking because they've been saying it for such a long time, they've lost credibility. But then the bubble blows up. And people go back and say, 4 years ago you said this. I wish I'd listened to you. So you get vindication. But it's a long, painful process. And I guess it shouldn't be a surprise that because the fiat currency fractional reserve banking system is global and, multi-trillion dollars in scope, that it's flexible, that it's able to, to use Soros's term, shamble along as a zombie, even though it's been killed quite a while ago, for longer than anybody thinks is reasonable. But it'll eventually blow up,
And they changed the accounting rules for the banks, so the banks don't have to mark their assets to market. So the banks are the only industry that is allowed to do that. And if any other company does that, it's fraud. It's accounting fraud. And so, there's been tons of rules changes. The other thing, John, is that this is a race to debase. So a lot of people, I know you guys initially were talking about this, thought the Federal Reserve would be the only one doing the QE programs, but look how much the European Central Bank has. So the last couple of years, the European Central Bank, the Bank of Japan, and the People's Bank of China have done lots more QE than the Fed has. Now, a lot of that capital that's been created, that currency, has come to the U.S. to asset prices. So the stocks, the bonds, the real estate here in the U.S., that's been bought up with currency printed in those other countries. China, John, the last 10 years, China's created a record amount of credit. They created almost 40 trillion US dollars worth of credit, and I can guarantee you that a lot of that money did not stay in the Chinese economy.
Yeah, well, China's been exporting their own inflation for quite a while now, because they're creating huge amounts of money. Actually, I should say they're exporting deflation by inflating domestically. They're creating a lot of currency at home. They're building out their infrastructure on an absolutely unprecedented scale, and the factories that they're building are flooding the world with cheap stuff. So their inflation leads to deflation for us, pushes our prices down. Again, this is all balances out in the end because China overbuilt. And so that's very deflationary for them because they've got, entire cities that nobody lives in, airports nobody flies into, roads nobody drives on. Those things aren't generating the cash flow necessary to pay off the debt that was taken on in order to build them. And when the cash flow is sufficiently inadequate, the entity that did the borrowing goes bust. And China is on the verge of that now, and they're really struggling to keep all these, these local government entities that are kind of quasi-state and quasi-private sector that borrowed literally trillions of dollars in order to buy stuff that nobody wants or uses. They're trying to keep those things afloat because to have them go bust would mean millions of people get laid off. And China is terrified of civil unrest. They had a civil war in living memory. There are people alive in China now that remember the communists versus the nationalists and what happened after that. So they'll go to any length to keep that from happening. They're kind of like the Germans with inflation. They remember inflation. They remember a hyperinflation, so they don't want it ever to happen again. China remembers civil unrest. And so we're in a pure capitalist system. You just let these over-indebted borrowers go bust. Somebody else buys up their assets nice and cheap, and the system goes on. You can't do that in a place where there are literally hundreds of millions of people who would hit the street in a situation like that. Yeah. So China's in a box. We're all in boxes of our own making, but China's is particularly intense because theirs is more physical. That theirs is more French Revolution-ish, if it happens, where the leaders are physically threatened by what would happen if they let all this debt be wiped out via default. So there isn't a major country in the world that doesn't have some version of this problem because we've all borrowed way too much money. With the possible exception of Russia, they have not overborrowed, but they've got issues of their own that don't necessarily have anything to do with the debt crisis, but still, But you look at Europe, their unfunded liabilities are insane. There's no way that they can support their retiring baby boomers based on the incomes of their millennials. They can't do it. So they basically have just been running a pay-as-you-go system and borrowing the money that it takes to take care of the baby boomers. That's going to blow up on them. Japan has borrowed more money at the federal government level as a percent of GDP than any country in history. And they're continuing to borrow money. People describe Japan as an old folks' home, a retirement center with national borders, because their population is aging so fast that's what's driving their costs up, and there's no solution for that. The U.S., we are wildly over indebted, especially if you include the Medicare and Social Security obligations and the state and local public sector pension fund obligations that haven't been funded. We're functionally broke. If you had to account for our finances in the U.S. honestly, there would be no doubt. It would be obvious that our assets are inadequate to cover our liabilities. But we get away with not really having to report them in a way that is obvious to most people. But anyhow, you look around, it's always like that everywhere. And it's just a matter of time before somebody blows up. I'll go out on a limb and make a prediction for what blows up first. Illinois. in the U.S., Illinois has underfunded its pensions to the point where that one thing is literally in danger of making the state and the city of Chicago go bankrupt here in the next few years. Their bonds, Illinois state bonds, are one notch above junk bond level, and they continue to borrow huge amounts of money without getting their act together in any other way. So it's just a matter of time before they get pushed down to junk level. Their interest rates spike, and yet they have to continue to borrow. And then they enter this death spiral where their borrowing costs exceed what they earn on their pension fund assets, and the underfunding just explodes. And, there we are.
We'll be right back with John Rubino after a word from our sponsor.
Do you work out routinely and eat healthy almost all the time? If you eat paleo or vegan or work out routinely, you may be eligible to save up to 33% off on your life insurance thanks to Health IQ. Health IQ is a venture capital-backed, big data technology life insurance company that offers customers life insurance at special rates by using the latest technologies. For more information, please go to healthiq.com/WS4MS. That's healthiq.com/WS4MS. Their politicians, John, don't see that as a problem. I know in the last year or two, they tried to increase property taxes by 33% in a short order, and so it sparked off a huge exodus out of that state. So, politicians see that as, we have a revenue problem, no problem, we'll just raise taxes and people will pay. But in reality, that's not what happens. So, when you try to rapidly raise taxes like a 33% property tax hike, a lot of people aren't going to just stand there and take it. They're gonna figure out ways around that, or they're gonna leave.
Yeah, capital is pretty mobile. So whether it's people, buying a house in Texas or something like that, or moving their business to New Hampshire, people are leaving Illinois because it's such a badly run place, and that just makes the problem worse.
Yep.
And there really is no solution to it because,
the solution they don't want to hear. It's painful. It's like you have to cut government spending, right? You can't make promises to buy votes. You cannot promise unions and teachers associations, these lavish retirements where they're getting 80% of their teacher salary until they die, and Cadillac health insurance, because the pension fund managers don't have the money to manage. So you can't. The politicians for decades, right, have made those types of promises. It's not just Illinois, but Illinois looks like the first one to go, like you said. And
another problem with Illinois is that they've tried to do those things, Jason, and the courts have told them that a contract is a contract. You made these promises to your teachers and your firefighters. You cannot cut their benefits. And so they then have to go back to the drawing board, and there's nothing on the drawing board that'll work for them. They're just descending into chaos.
That's the contracts are going to get forfeited. So there's a math problem. It's just not going to work.
Oh, and here's where it gets even stranger. States don't have a mechanism for going bankrupt. They don't have Chapter 11. So there's no legal way for them to stiff their creditors and renegotiate those contracts. A city can do it, but states can't. So to the extent that these liabilities are at the state level, it's just not clear what happens. Something will happen, but it's not clear what that will be.
Yeah, we're gonna have a lot of things tested probably in the next crisis, maybe even sooner than that. There's just, I call them economic landmines. There's so many of them that are $1 trillion in size or more. I don't remember this many prior or during the 2008 financial crisis. It really seems, John, that with the rules changes, in order to pretend that there was a recovery, they allowed all these extra credit bubbles and asset bubbles to grow to like $1 trillion in size or more all over the global economy. So you have like the subprime auto loan bubble, you have the shale bubble, you have China's credit bubble. I mean, Gordon T. Long I interviewed a couple months ago, he said there's over 40 of these things.
Well, and a lot of the smaller bubbles are starting to burst, which is interesting. The subprime auto bubble is already flat out bursting. There are no more subprime borrowers going to showrooms, and the private sector lenders who specialized in those kinds of loans are starting to die off. And the way systems usually turn down, the way something breaks down is that problems start at the periphery and then they work their way into the core. So that might be an example of something at the periphery that's going wrong that's not big enough by itself to threaten the whole system, but you get 2 or 3 of those things and then scare people into looking around for what's next, and then they find a whole bunch of things that are next, and that's how a system spins out of control. So that's an early warning sign, and we'll see if there are more and what happens when they start to go. I think student loans are another thing that should blow up. And then
even President Trump for student loans, though, he's talking about some type of forgiveness plan, which is worrisome to me, considering I had to pay off my loans. So, and my parents helped me, but I mean, like people now, if you're going to get a bailout, why not just max out the total loans then? If you're going to get a bailout, so it creates if you're going to get a bailout or think you're going to get a bailout, it just creates perverse incentives throughout the system, and it's not fair at all.
Yes, I agree. But we're past the point where we're thinking about what's fair. We're thinking about survival right now. The politicians and the central bankers are basically thinking, what do I need to do to get through the next election cycle or the next corporate earnings season or whatever? They don't have their eyes firmly on our grandchildren's welfare when our grandchildren are adults. They couldn't care less. Or if they care, it's back burner versus front burner. The front burner is, how do we keep the financial system from blowing up this week, and the answers are becoming fewer and farther between. So that's why we're going to get such extreme stuff in the not too distant future. Get ready for negative interest rates in the U.S. and the war on cash. They will probably in the next cycle give us a Fed funds rate of negative 2% and a ban on $100 and $50 bills.
So you think the Fed is just hiking rates to prepare for the next crisis so they can lower them then? Because if
yes.
they do want negative rates, then why are they raising them now?
Well, because they need ammo. What the Fed traditionally does is it raises rates against an expansion, as an expansion goes on. And then when the recession inevitably hits, they have some leeway. They can cut the Fed funds rate from 5% down to 1%. Well, we didn't have that until just lately. We still don't really. What's the Fed funds rate now, like 2% or something? They want to get to 5% so they can do what they did in the past, cut rates and in that way moderate the next recession. But if the next recession starts when short-term rates are 3%, that's probably not enough. So they can't just go to 1%. They've got to go to 0, then they've got to go to -1, then -2. And count on them to do it. They will do whatever it takes to prevent the leverage that's in the system now from blowing up and taking us all down with it.
And John, I think one of the main reasons the people in power, the economic and political elites at the central banks and at the government levels have gotten away with this for 10 years since the 2008 financial crisis is a lot of people on Wall Street, both political parties on Wall Street, although most of the people on Wall Street now are rich Democrats, but also a lot of regular everyday Americans, not necessarily people who see the world the way you and I do. They really don't care if money's printed or anything. I've tried to have discussions with regular people. They do not care. Regular people on Wall Street do not care as long as the stock market is going up, as long as the bond market does not crash, and as long as their home prices have not crashed either. So no one is complaining. Everyone's happy. You try to explain it's devalued currency. It's inflation that's driving these asset prices higher. They're going to have to pay more taxes. They're asleep at the wheel. They're complacent. They don't really seem to care about why things are going up as long as they're going up.
Yeah. Well, I mean, if your stuff is going up, you're smart because you made the decision to buy that stuff. The market is validating your good judgment. That's how bubbles work. More and more people come to believe they're geniuses. And it's only when a really large percentage of the population thinks that way and doesn't really do risk assessment anymore because they're geniuses. Why do they need to look at price earnings ratios or anything like that? That's when it blows up, because that's when you get the really bad decisions being made. That's the guys who bought Bitcoin at 17,000, 18,000, and 19,000 were like that. They thought this is going to 1 million. And I'm a genius because I bought some at 8,000 a year ago. Therefore, whatever I buy now is going to go up because that's how smart I am. And markets teach humility. That's just how they work. And, same thing with gold at $1,900 an ounce. A lot of people bought there because it was going to go up forever. Every bubble is like that. And this one, because it's so broad-based, is causing a much, much, much bigger than ever before misallocation of capital. You got people buying government bonds that yield zero because government bonds have always gone up. You got people buying stocks that, have in the aggregate have a PE ratio that's as high as it's ever been, as high as it was in the 1920s, 1929. Or in 1999 at the height of the tech stock bubble. And you've got people buying stocks because stocks have been going up for such a long time. They can't imagine them not going up anymore. That's how bubbles work. And when they blow up, you'll have people selling stocks at 75% below today's prices because stocks always go down. That's also how bear markets work. You feel so stupid, you don't want to be in anything.
And also mentally, they can't take the pain anymore. So they just want to cut their losses and forget about it. Whereas if they, if you had done that in 2008 and 9, if you had known that the central banks were going to step in, there were people who were selling at the bottom then. That was the time to buy with blood on the streets. If you knew the central banks were going to overreact and come in and inflate, that was one of the best buying opportunities of the generation if you went in there and bought a lot of different assets when there was blood on the streets.
Yeah, well, that's how it always works. That's how you get a market bottom, is when people sell unwisely. Because they panic. They can't, like you said, they can't take the pain anymore, or they just don't trust their judgment anymore, and they want to get out and be in cash because cash doesn't change. Cash can't betray you by going the wrong way.
Until there's negative interest rates, right? That's taxing you to keep your money in the bank.
Yeah. That's a sign of a cash bubble, right? The money bubble, as James Turk and I called it in that last book. When people buy money or things that depend on money at really unreasonable prices. In other words, if you own dollars right now, you're owning a depreciating currency with a wildly over-leveraged financial system. That's a bad idea. If you buy government bonds that pay you in these fiat currencies, that's an incredibly bad idea. And it only seems like a good idea because we're in a bubble. Bond prices have gone up for 30-some years, and interest rates have fallen since literally 1980 until just the last couple of years. So they're always going to do that because they've always done it during your adult life. That's how you get bubbles. And the sovereign debt market is clearly a bubble. It's maybe the biggest of all of them in the world.
Yeah, because the governments transferred the risk from the private sector banks onto the central bank balance sheets and the governments themselves. So that was the way to delay all that pain that we should have gotten during the 2008 financial crisis. There obviously was pain there, but there should have been a lot more pain during 2008, and we didn't get that because in a lot of aspects, the politicians didn't want to be voted out of office. They didn't want the pitchforks, so they just kicked the can down the road with these trillions and trillions of dollars of whether they were currency swaps or QE programs or liquidity injections, whatever the heck you want to call them, a lot of different types of covert and overt programs in order to delay that pain. But they've made things worse now. They've made the wealth disparity worse, John. So, a lot of people who didn't provide any value to society for the last 10 years, they didn't create a new product or service, they didn't grow their business and create new jobs in the real economy. They just had a portfolio of stocks, bonds, and real estate, and they've gotten rich from that instead. So that's not really beneficial to society then.
No, it's not. But it's beneficial to the guys making policy because they and their buddies got incredibly rich. So basically what they did was they just spent 8 or 9 years here sucking money out of the middle and working classes and shoveling it over to, bank vice presidents and hedge fund managers and congressmen and et cetera, et cetera. The political and the financial classes got extremely rich. at the expense of everybody else. And people don't put up with that either. That's how we got Donald Trump. That's why the nationalist president of Hungary just got reelected in a landslide. That's why Marine Le Pen is still liable to be the next president of France, and why Brexit happened.
And Bernie Sanders is still really popular too, even though he's a socialist, right? But he's a populist, right? So he says things that a lot of young people in millennials and Generation Z want to hear.
Yeah, see, the way you win elections now is by standing up and saying, you know what, there's a bunch of rich people out there who are ripping you off. I will fix that. That's all you really have to say. And then everything else is just detail, because people care less about how you're going to do it than that you're trying to do something for them. Because, you get Hillary Clinton standing up there saying, everything's going pretty well. We're going to stay the course. We're going to cut new free trade deals, and we're going to let in lots more immigrants, and, stuff that people who have been disadvantaged by this economy feel like is hurting them. She was the spokesperson for all of those things. And so, Trump stood up there, and he didn't make tremendous sense when he was talking about what he was going to do, but all of it was aimed at helping working class people. And that's how he got elected. And that's why Brexit happened, and et cetera, et cetera. So that is such a great market niche right now in politics that you'll see somebody in every election staking out that territory and winning.
So a couple more questions before we wrap up the interview. You mentioned President Trump. He's been talking about unfair trade deals for a very long time, long before he ran for president. He was talking about it all the time in his campaign. So at least, I'm not in favor of this trade war that's escalating. I think it's going to create a lot of collateral damage and hurt a lot of innocent Americans in a lot of different industries, farmers and others. I did a short video on this yesterday, and an American farmer commented on the video that they're really worried that the retaliation from China is going to hurt them. So what's your view on this U.S. versus China trade war that's looming, that President Trump and, China, they're basically just at this point every day or every other day, they're, escalating things with new potential tariffs and new threats?
Well, that's Trump keeping a campaign promise. And China has been getting away with a lot of stuff. So it's not a surprise that there's this tension now between us with our huge trade deficit and hollowed out manufacturing base, and China with a huge trade surplus and really fast manufacturing growth, and which they've achieved by cheating in some ways. It's not a surprise that there's tension. But I think we'll probably work it out. It's in nobody's interest to be slapping tariffs on each other and cutting our currency valuation relative to theirs and back and forth like that. We don't need a currency war or a trade war. So I think there's a place where they can meet that gives Trump a lot of what he wants, preserves a lot of what China has, and then we go on from there. I don't see this as being some big disaster.
I really hope you're right, because what I saw today, it sounds like China is going to stop buying U.S. Treasuries at least for a while. So if the Fed was planning in October of starting to reduce its balance sheet, quantitative tightening, or QT, reducing its balance sheet by, I believe, $50 billion per month, if China is going to stop selling Treasuries, who's going to buy them then? And that's on top of the massive budget deficits that President Trump wants to run. I believe we're looking at $1.2 trillion approximately budget deficits going forward in terms of the projections for the remainder of the Trump administration. And I think there was a lot of borrowing that was delayed by President Obama. So the Treasury in the next 12 months or so, John, we need to go raise $1.8 trillion. And if China is not going to be one of the buyers, I really don't know who's going to be buying all those Treasuries.
Yeah, we'll see.
I'm glad it's not my problem, right?
Yeah, I mean, there's so much that doesn't work out there. So, this is one, and there are many, many others. So something is going to blow up. Something is not going to work because it doesn't work. And there's no way to know which it'll be. But I think the story of the next few years is going to be extreme volatility until that volatility leads to some kind of a crash in some major asset class that metastasizes to others. And there's no real way out of it.
Actually, I was going to ask you about that. What would be, if you had to guess, make some educated guesses, what would be your big themes or trends for 2018? And I was going to bring up volatility, that I thought, really in the last 6 months or so, we've seen volatility just start to come back, where in the stock market, we've seen 2% up and down, 2% up, 2% down, whipsaw days, which normally when you see something like that, that means the stock market's trying to put in a top. So do you think then that volatility is going to be one of the major ones? Do you see anything else besides volatility then?
Oh, volatility and government intervention and precious metals. Those three will be big stories for the next decade, I think.
Well, I don't know how much more government intervention we can take. I mean, are we going to see entire industries bought up? Are
Sure.
we going to see?
Yes, that and lots of other things. They'll have no choice.
Wow, that's crazy. I mean, the rules changes. So with the money bubble and the dollar collapse, I mean, all these other governments just joined in on this race to debase with the fiat currency, with all these other QE programs and expansion of their balance sheets. So I don't think most people saw that. Did you see that the Swiss National Bank actually has publicly traded shares and their shares have gone parabolic?
Yep, it's a growth stock. That might be the thing we look at in retrospect and say, oh, that's how we should have known it was a bubble. But anyhow, Jason, I have to hop now for the next thing. So
sure,
it was great talking to you, and let's do it again soon.
And if our listeners want to follow your work, buy one of your books, or check out your articles on your website, how do they do so?
Dollarcollapse.com is the website. It's updated all the time, and you can buy my books from that site.
Hey there, it's Mike the producer. Have you picked up your copy of Collusion, How Central Bankers Rigged the World by Nomi Prinz at our special 40% discount rate? Just go to 800ceoread.com/Wall Street. That's 800ceoread.com/Wall Street.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street from Main Street YouTube channel if you have not already done so. We're closing in on the 20,000 YouTube channel subscriber milestone despite YouTube censorship, and hopefully we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down the channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street from Main Street email list that's on the wallstreetfrommainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetfrommainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing you guys with some of the best information, analysis, and financial education available out there for free or paid.